Video on the key functions of central banks, and the topics we're going to look at is the role that central banks play in implementing monetary policy, the role that central banks play in terms of being the banker to the government. Central banks also operate as a bank to commercial banks. So what I mean by that is the likes of NatWest or Barclays. So they have an account with the Bank of England, Britain's central bank. We'll explain this idea of lender of the last resort as well. And then finally, we'll look at the issue of regulating the commercial banking sector. In some countries, central banks are also responsible for that too. So the first topic we're going to look at is the role that central banks play in terms of implementation of monetary policy. So we'll look now then at monetary policy. So central banks issue a nation's currency. For example, in Britain, the Bank of England issues sterling, our currency, in the form of paper banknotes and coins. Central banks use monetary policy to influence the level of aggregate demand in the economy. They do this to achieve macro policy objectives. Monetary policy involves central banks changing the base rate of interest and the money supply. That's basically how they go about influencing the level of aggregate demand. So you would say that monetary policy is a demand side policy. The other thing to bear in mind is at the moment central banks are obliged to set monetary policy with sole reference to an inflation target, and this approach towards monetary policy is called inflation targeting. The image there just shows some of the names of some of the world's most famous central banks. So when people refer to the Fed, they're referring to the American central bank called the Federal Reserve. They set interest rates in America. The European Central Bank is the central bank in charge of setting monetary policy for the whole of the Eurozone. This slide really is a recap from theme 2. So, you should really look back at the topic of the monetary transmission mechanism, which is all about how interest rates can affect the level of aggregate demand. You need to be able to explain the transmission mechanisms. So, obviously, if we think back to consumption, interest rates will affect consumption because they'll affect households' propensity to save. As income can either be consumed or saved. So, for example, if central banks cut interest rates and reduce the rate of return available to savers, they'd respond to that by saving less, which would imply an increase in consumption. Another thing that you've got to bear in mind as well is that interest rates will affect people who've got mortgages. So if the interest rate falls, people's disposable incomes will rise because their monthly mortgage repayments will drop, if they're on a repayment mortgage that's variable, and that will give them more money available, more disposable income available to finance consumption with. And then the final reason why interest rates can affect consumption is that many big ticket items such as cars are typically bought on credit. So when the interest rate falls, demand for those products that are typically bought on credit rise because the monthly repayment drops. Investment, obviously, interest rates affect that, so you need to look back at the marginal efficiency of capital theory of investment, and also the classical kind of alternative, which is this idea that saving indirectly influences investment because savings provide banks with the loanable funds needed to make loans to businesses who want to borrow those loanable funds to purchase capital. So, an Austrian economist would say that low interest rates actually could have a damaging effect on investment because low interest rates is going to disincentivize households to save, and that will lead to a shortfall of loanable funds. And if banks don't have loanable funds on deposit, they won't be able to make loans to businesses who want to borrow to purchase capital. So investment will fall. So there's a big debate there about the role that interest rates play in terms of stimulating investment. Keynesians argue that lower interest rates will encourage investment. Classical or Austrian economists assume the opposite. And then the final thing to bear in mind is that if you cut interest rates, that will reduce the rate of return available for foreign savers who want to save in your currency. As a result of that, hot money will flow out of your currency. That will increase the supply of your currency on forex markets, leading to an exchange rate depreciation. Providing that you meet the Marshall-Lerner condition, lower export prices and higher import prices will push the current account of the balance of payments towards surplus. So this is another way in which monetary policy can affect aggregate demand through the last component of aggregate demand, X minus M, net exports. You'll also need to remember that monetary policy these days is also about quantitative easing. So this is the idea that central banks can increase the money supply, and that will affect consumption, investment, net exports as well. You'll also be expected to know why QE hasn't worked. So you should have some notes all about that from theme 2. So I'm not going to waste any more time talking about that, but that's just a heads up to you guys that you need to revise your theme 2 notes and know all about the ins and outs of quantitative easing. This next slide again is just a recap really that we know that in Britain the Bank of England pursues an inflation targeting approach to monetary policy, and they're supposed to set monetary policy to achieve a CPI rate of inflation that's somewhere between 1 and 3% over the next 12 to 18 months. Because monetary policy is subject to a time lag, when the Bank of England makes its monetary policy decisions, they make it with reference to a inflation forecast. So if we look at this inflation forecast on the screen, the forecast was made at the beginning of 2011, and at that time the Bank of England was expecting the rate of inflation in 2 years' time to be about 2%. So obviously there was no need to put interest rates up or down because inflation was going to be exactly bang on target according to the Bank of England. Again, this is just some recapping really. What else could central banks consider when setting monetary policy apart from the rate of inflation? Well, I guess they could consider debt levels. They could consider the exchange rate. They could consider the rate of unemployment, and they could also be interested in asset prices. So, for example, if they saw a bubble emerging in the housing market, the central bank could raise interest rates to try to reduce demand for housing, cooling the bubble or stop it from inflating any further. But as you know, what's been very, very controversial over the last decade or so is that central banks have been asked to forget about debt, forget about exchange rates, forget about unemployment, forget about assets prices, forget even about economic growth, and they've been asked to set monetary policy with sole reference to a forecasted rate of inflation. This is the inflation targeting mantra. So we've lived through this era of very low interest rates. Many economists argue that this has led to growing inequality. Those that get to spend the newly created money benefit most. Those that receive it later benefit least. And this is called the Cantillon effect. So this is a decent program to watch, the Kaiser Report. If you were to type this into YouTube, you can find this video. Well worth a watch if you want to get your background knowledge up to A-star standard. Okay, what we're going to look at now is the second role or key function of central banks, which is central banks act as a banker to the government. The government collects tax, which is used to finance public spending. We know that. The government keeps their cash balances with the central bank, and payments are made by drawing cash from this account. Central banks can give governments temporary emergency loans when the government suffers from a short-term cash flow problem maybe tax receipts haven't come in because, I don't know, there's been a pandemic or something. The central bank can provide short-term liquidity by printing the extra money required by the state so it can pay its obligations to its own citizens. The government must repay the money it's borrowed from the central bank. The central bank then destroys the cash it receives so that the money supply doesn't increase in the long term. Obviously, this has all gone slightly off message these days because the government is actually quite keen for the Bank of England to create a permanent increase in the money supply, through QE. But this was the situation prior to 2008 that I think you would be reasonably expected to know. So if the government wants to borrow over a longer period of time to run fiscal deficits, what they shouldn't do is ask the central bank to just print money to finance government spending. What government should really do is to finance their fiscal deficits by selling bonds. So what happened to the Greek government when they wanted an emergency loan from their central bank in 2015? Well, basically the Greek government's central bank was the ECB, or is the ECB, the European Central Bank. And because the European Union are such nice guys, they actually turned the Greek government down. So they denied the Greek government of emergency finance from the central bank. Quite a controversial move, when Greeks can't get, Greek public workers can't get paid, or pensioners can't get paid, or Greek banks need money to meet demands from customer withdrawals to withdraw their savings, not there because the ECB decided to play hardball with the Greeks. So debt monetization is again something that when I first started teaching economics, this was the sort of thing that people in Britain laughed at developing countries for. The idea that that governments would attempt to monetize their national debt would be just laughed at, but it's actually happening now in 2020. So governments, as I say, they're supposed to borrow by selling bonds. Under conventional QE, the central bank prints money and it uses the money that it's printed to buy government bonds. Up until recently, the bonds couldn't be bought directly from the Treasury because that was called debt monetization, and it was forbidden because this practice has got a long history of creating very high levels of inflation. So instead, the central banks are only allowed to use quantitative easing to buy second-hand bonds that were owned by financial institutions who bought them previously from the Treasury as an investment. So, debt monetization is when all of that is just circuited, and the government wants to run a massive fiscal deficit. They can't find any buyers for their government bonds, so they just phone up the central bank and just get them to print the money that they need to finance furlough or bounce back loans. And the problem with this approach is that it causes inflation, hyperinflation, which is surprisingly common. Something that we might see in a not too distant future is the idea of people's quantitative easing. So that involves the central bank creating money to buy government bonds directly from the Treasury. So that's debt monetization, but the money is not going to be used to finance banker bonuses or even welfare. And the idea of people's quantitative easing is that the printed money is going to be used to construct infrastructure, like HS2. It might be quite interesting to see as well if an attempt is made to finance a universal basic income through people's quantitative easing. Milton Friedman called that helicopter money, and if you could even, if you issued that helicopter money digitally, you could also incorporate a negative nominal interest rate to try and get the velocity of circulation going. So you could say to people, look, here's a digital card, it's got £5,000 on it, but in a month's time it will only have £4,000 on it. In 2 months' time it will only have £3,000 on it. So the idea there would be, it would be encouraging people to spend that money as quickly as possible. So Keynesians would like that because it would obviously boost aggregate demand, and they think that that would lead to an increase in output and employment. So this has all been in the news. Paul Mason, Channel 4, he was a Channel 4 journalist, writes for The Guardian. He was advising Jeremy Corbyn to use people's quantitative easing. Citibank have also been sort of saying that this is a possibility too. It is a possibility. I think it's going to happen, but it would need a digital currency, I think, so that they could get the nominal, negative nominal interest rate going on it. What are the dangers of it? Well, again, linking back to theme 2, if you believe in monetarism, if the money supply grows at a faster rate than the economy, T, the result will be inflation, an increase in the average price level. So people like me who do believe in monetarism argue that it's quite dangerous to use quantitative easing. Okay, it might not create inflation immediately if velocity is close to zero, but the thing about velocity is it's unstable, and you could easily get into a feedback loop between V increasing, that leads to an increase in price, which leads to even faster velocity, and rinse, lather and repeat. And that's basically what happens in a hyperinflation. The government creates, or the central bank creates, loads of money. Initially maybe it doesn't create inflation, but then something happens to spook the populace, velocity increases, that's enough to increase expenditure, that increases receipts, the price level goes up. An increase in the price level spooks households a second time. They feel even more inclined to spend their income quickly before it loses value. That leads to further increases in expenditure, further increases in the price level. So again, if you're an Austrian economist, this is why we believe in gold and silver as the ideal form of money. Over human history, economies have grown about, I don't know, 3 or 4% a year, which isn't too different from the increase in the supply of gold and silver that can be extracted from mining it from the ground. So what you've had when gold and silver have been used as money is a well, no inflation at all, actually mild deflation, because the economy tends to grow marginally faster than the gold or silver money supply. So gold and silver perform very well as stores of value. And because they perform really well as stores of value, they're obviously right. So we're now going to look at central banks and the role that they play as acting as a banker to the commercial banking system. So what you need to know about banks is that banks collect money from savers. They pay savers a relatively low rate of interest. They then use savers' money to make loans to borrowers, and they charge borrowers higher rates of interest than they pay to savers. And that difference in interest rates is the bank's gross profit margin. So yeah, it obviously makes sense for commercial banks to lend most of the money that's deposited with them by savers. The more that they lend out, the more interest income that they can generate from the people that they've lent the money to. They Commercial banks will hold back some of the money that's deposited with them, because some of their savers will turn up at the bank and want to withdraw some of their cash. So you need to have some cash on deposit to meet that requirement for savers who turn up at the bank who want some of their money back. Sometimes commercial banks don't have enough cash at the bank to meet cash withdrawals on a particular day. And in this situation, central banks borrow on a short-term basis from the central bank when they've got a temporary liquidity problem, when they haven't quite got enough cash in their bank vaults to meet all of their customers who have happened to come into the bank on that particular day wanting some of their cash savings out. This incidentally is what happens during a bank run, when people, customers, savers lose confidence in a bank and they all turn up at the same time wanting all of their savings out. Obviously, no bank can survive that because banks make profit from lending savers money out. They don't actually keep the savers money in the bank vaults because they wouldn't be able to make any interest income on that. So by acting as lender of the last resort to the commercial banking system, the central bank helps to engender the public's confidence in the commercial banking system. You know, when you put your savings with NatWest or Barclays, you don't worry that if you were to turn up at the bank on a particular day, the bank wouldn't be able to give you your money back. Even if they were to lend out like all of their deposits, which they wouldn't be allowed to do according to banking regulations, the Bank of England would provide them with emergency liquidity so that people that wanted their money out from the bank could get it. So you also need to know what the base rate of interest is. Commercial banks like NatWest receive interest on the cash that they hold to meet their customers' demands for cash withdrawals. The rate of interest that the Bank of England pays on reserve balances held by commercial banks and building societies is called the base rate of interest. So in November 2016, the Bank of England's base rate of interest was 0.25%. So that's what the base rate of interest is. If NatWest puts some of its surplus cash on deposit with the Bank of England, they'll receive this rate of interest called the base rate. Okay, moving on, what we're going to look at now is the role that central banks play in regulating the banking industry. In some countries, the central bank does this actively. In the UK, the Bank of England has set up a quango to do that role for it. So a bit of background information first. Central banks, like the Bank of England, have got two objectives. The first one is price stability, so keeping the rate of inflation in the UK's case to within a percentage point of a 2% central target. Central banks also have a second objective, which is called financial stability. And financial stability is achieved when commercial banks are profitable and are not at risk of failing, going bust essentially. So financial stability is also achieved when the general public are confident that their commercial bank with whom they have their savings with is not at risk of going bust and they're not going to lose all of their money. So to achieve financial stability, central banks need to find a way of persuading commercial banks not to make big loans to borrowers on low incomes who are unlikely to repay the loan. Simple reason for that is that if a bank was to make stupid loans to people on low incomes who couldn't repay the loan, the commercial bank would go bust, and when banks go bust, that's financial instability. So commercial banks have got to keep an eye on the commercial banking system to make sure that they don't make too many silly decisions. So to achieve financial stability, the central bank must also convince households and firms that commercial banks are trustworthy. If that's not the case, then what people start to do is put their savings under the mattress and store their wealth outside financial markets, which creates problems because businesses can't obtain loanable funds to purchase capital with if households are stashing their savings at home under the mattress rather than inside the banking system. So to achieve financial stability, central banks use financial regulations to outlaw risky lending practices that would cause defaults, banking losses, and thus a financial crisis. So there's another video featuring Max Kaiser there. He's normally well worth a listen to on the topic of financial stability. He's used this phrase, which I think is hilarious. He refers to suicide bankers, which is a play on words. It's meant to sound like a suicide bomber, and a suicide bomber was somebody that blew themselves up. And according to Kaiser, in the lead up to the 2008 financial crisis, many commercial banks were making absolutely suicidal loans to people that didn't have a hope in hell of ever being able to repay those loans. So in the UK, the British financial system is regulated by the Financial Conduct Authority, the FCA. And the role of the FCA is to protect consumers of financial services. So the FCA is supposed to protect consumers of financial services such as mortgages, credit cards, loans, savings and pensions. They do this via regulation. Only firms that meet the standards set by the FCA are allowed to trade. Firms already operating in the market, the financial markets, are also monitored to ensure that they're following the FCA's rules. The FCA has the power to fine banks that break its rules. They can also remove the bank's license to operate. Yeah, this is an important point. So in the UK, it's very, very difficult to get a banking license. So the plus side of that is that, well, banks should be pretty well regulated then, because you've got to jump over many, many regulatory hoops to get a license. The drawback of this, of course, is that it limits competition in the banking market. If it was easier to get a banking license, there would be more competition within the industry, and perhaps maybe savers would get higher interest rates and borrowers would get lower interest rates. The FCA apparently also encourages consumers of financial services to contact the FCA if they believe that they've been missold a financial product. So a true story here. There was a guy that I used to play cricket with. He was maybe only 20 years of age, and I remember him coming to speak to me after a training session. He knew that I taught economics, and he was really proud because he'd just had an interview with a financial planner. And this financial planner had got him to purchase a life assurance policy, which was a very, very immoral thing for this guy to have done, because my mate Dipan didn't have any children or dependents. So why this guy thought he needed life assurance was beyond me. So that was an example of mis-selling. He was sold a financial product that he didn't need. Yeah, so the FCA is supposed to investigate allegations that people have been misled because a financial advisor has exploited an information asymmetry that's been in their favour. The FCA also brags that they're there to enhance market integrity. So yeah, so the FCA tries to convince households that they should have greater trust in the financial services industry. The FCA knows that this is important because the demand for financial services depends on it. In other words, you're more likely to buy something from somebody if you trust them, especially if it's about a product or a service that you're not particularly familiar with. So the FCA tries to build public trust in the financial services industry by, well, three things. Number one, supervision. So the FCA is supposed to check that banks and pension funds acting as agents on behalf of their clients put clients' best interests at the heart of their businesses. So, again, you hear these sorts of allegations that people employed to look after people's pensions, they'll select shares in companies. If those shares perform well, they'll move those shares into their own pension fund account, and maybe they've bought shares that haven't performed particularly well, and what they'll do is move those shares into the client's account. So that the FCA is supposed to make sure that financial advisors and pension funds are acting on their clients' best interests rather than pursuing their own self-interest. Number two, promoting a positive culture of proactively identifying and managing conflicts of interest. So a conflict of interest is a situation where you're supposed to do one thing, but you decide to do another because doing that other thing is more financially beneficial to you. How the FCA does that, I'm not too sure about really. It just seems like just some waffle to me. Number three, again in quotes, which I think implies for me that I think that this is waffle. Monitoring the actions of financial services firms to ensure that their business models maintain trust in the integrity of markets and do not create or allow market abuse, systemic risk or financial crime. So they're supposed to make sure that the financial services businesses, they don't try to rig markets, form cartels, do insider dealing where they purchase shares on information that they alone know. Again, just how they manage to do that. You know, you can say that we're going to promote this, we're going to do that, but for me, it's just empty words unless you've actually got a mechanism for achieving those goals. So what we're looking at here then is this whole area of principal agent problems. So my son, Joe, he might want, he's inherited some money, so he goes to an insurance company. What the insurance company is supposed to do is to invest his money in a manner that's going to be best for Joe, for him. But will they, or will the person employed by Aviva try to use his money to make as much money for himself? Will he pursue his self-interests rather than the client's self-interest? The FCA is also supposed to promote competition. So according to the FCA's website, competition empowers and informs consumers. Markets work best when consumers can take their business elsewhere if they're not happy, and firms know that. Well, I can't disagree with anything there at all. And I would say if the FCA was going to do that, they need to make it a bit easier for new entrants to join the banking market by making it less hard to get a banking license. So the next statement implies that the FCA favours behavioural economics to boost competition. So the quote from them is, there are many ways in which competition can be weakened. For example, firms may exploit consumers' difficulties in making the right choices about often complex services. So what the FCA is basically saying there is that the general public's thick. They're on the wrong end of an information asymmetry. And as a result of that, they're like lambs to the slaughter. They can be sold financial products with huge commissions that represent very, very poor value for money. And they might not even know that a cheaper provider exists because they don't shop around or something. Or they don't try to inform themselves before they make a decision about which provider that they're going to go with. So to make markets more competitive, the FCA believes that consumers need more information so they can make better use of the competition that already exists. So again, an example, a quote from them. When looking at retail insurance services, we found that regulation that forced insurance companies to disclose the premium consumers had paid the previous year was the most effective way of prompting consumers to shop around, cancel or negotiate their insurance policy. So I guess, you know, if you're told what the premium was last year and you can see that it's gone up, that might stimulate you to trying to find a cheaper deal. Something that I remember, I had insurance for my house in Croydon, business insurance, and I won't mention the name of the insurance provider, but it's, yeah, they advertise heavily on TV. Direct Line, yeah, I said it. And basically, my premium was £300, and they increased it to, well, by over £1,000 in 1 year. And well, obviously, I wasn't going to renew, but the letter that they sent basically said, you need do nothing. We will renew your policy automatically if you don't tell us otherwise. Personally, I found that quite outrageous that they did that or were trying to do that. Obviously, I phoned them up and cancelled and told them to get knotted. But, you know, if I'd have been on holiday for a month, then they would have just used my bank details from the previous year and just stolen the money from my account. Anyway, yeah, so I think if the FCA really wanted to promote greater competition in financial services, it would deregulate financial service markets, making it easier, to get a banking license, for example, would allow new challenger banks to enter the market, reducing the power of incumbents. Those are firms that are already in the market, so firms such as HSBC, NatWest, Barclays, etc. Another bit of good background information here is that, like Keynesians, they tend to think crazy stuff that monopolies are just like acts of God. They occur organically. Mises, in my opinion, has it right. According to him, monopolies more often than not are created by the state. State regulation, and this is a perfect example of it. Why isn't there more competition in banking? Is that a natural phenomenon, or is that a product of state intervention? For me, it's clearly the latter. So this quote from Mises is quite interesting. Manufacturing and commercial monopolies owe their origin not to a tendency immanent in a capitalist economy, but to government interventionist policy directed against free trade and laissez-faire. Yeah, so my evaluation, using regulation to protect consumers creates an unintended consequence, which is less competition. New entrants will reduce market concentration, increasing consumer choice. This is a far better way of lowering prices than providing consumers with extra information about the competition that already exists. And that's particularly true if the banks are running an illicit cartel that they're not really talking about. Well, they wouldn't talk about it because it's illegal, but who's to say, spooky coincidence, they all charge more or less the same rip-off interest rates on credit cards. They all pay similarly lousy rates of interest to savers. Is that just chance? Is that just a coincidence? Or perhaps there might be collusion going on there. So let's look at some examples of financial regulations. So the first one is a minimum reserve asset ratio. So, the government, or the central bank rather, could force commercial banks into holding £1 back for every £10 deposited with them by savers. And that will improve the liquidity of the commercial banking system, making it more likely that the commercial banks will be able to meet cash withdrawals from depositors. The second type of regulation is regulation pertaining to capital requirements. So banks can raise the cash needed to finance loans to customers by either attracting deposits from the bank's customers, savers, or borrowing from other banks, or by maybe selling shares in the bank. Capital requirements limit the amount that banks are able to borrow from other banks. A minimum proportion of the bank's capital must come from selling shares. Northern Rock failed in 2008 because foreign banks were unwilling to advance Northern Rock new lines of credit. So they were too dependent on borrowed money. So you could say, well, look, this creates instability. If they can't get their hands on more borrowed money from other banks, they'll go bust, and that creates financial instability. So maybe what we'll say is that we're going to limit the amount of capital that commercial banks can obtain through borrowing, taking out loans with other commercial banks, because that makes them inherently unstable. There are also regulations pertaining to this thing called corporate governance requirements. So corporate governance regulations are designed to ensure that banks are run prudently or cautiously. In particular, corporate governance regulations are designed to tackle the principal agent problem. The goal being to stop some bankers from crashing a bank by engaging in high risk activities in order to hit performance related pay targets. So the solution is to ensure that bonuses are linked to the bank's long-term success, not to its short-term success. So you could basically regulate banker bonuses. So, the central bank could say, well, look, NatWest, Barclays, etc. If you want to pay performance-related pay, this regulation is going to force you to pay that bonus in the form of shares rather than in cash. And the main advantage there would be that by being a shareholder, the banker would have more of a vested interest in creating a solvent bank that would be around in 5-10 years time, because their shares would still be valuable. Yeah, so just as a quick recap on this principal agent problem, the principal, in this case is the bank shareholders. The agent is the person that the shareholders have appointed to run the bank for them on their behalf. And often what can happen is that the agent might not be a very big shareholder. They're just in it to collect their salary and their bonuses. And what they can often do is try to go for strategies designed to maximize short-term performance, particularly if that's going to give them the biggest cash bonus. The problem with that is that this kind of risk-taking behavior can be at the expense of the principal's interest, the shareholder's interests, because if this mad, risky strategy fails, it's the shareholder that's going to lose everything. They lose their investment. The agent, the professional banker, what do they lose? Well, they just lose their salary and their bonus for the next few years, and they just go and look for another job. So you could argue then that financial regulation is needed to try to encourage agents to think more about the principal's interests rather than their own interests. You could also regulate to force banks to get credit ratings. So a central bank could force banks to obtain and maintain a credit rating from an approved credit rating agency. So the idea of credit rating is that you're judging the solvency of an organization, the likelihood of its collapsing due to losses. So financial products sold by commercial banks, they could also be credit rated to show the risk to potential buyers of those financial products. And this type of regulation aims to correct market failure caused by an information asymmetry between the seller of the financial product and the buyers. In the lead up to the financial crisis, banks paid credit rating agencies to assess the creditworthiness of many of the financial products that the banks were selling. So this was obviously going to create a conflict of interest. The banks wanted AAA credit ratings slapped on all of their dodgy financial products, because a AAA credit rating would ensure that people would be interested in buying those products. The credit rating agencies went along with that because that was good business from their point of view. If they'd have put a truthful credit rating on it, like, I don't know, ABB or junk credit rating, then the bank would have been pretty hacked off with that, because a lousy credit rating isn't going to help the product to sell. So the credit rating agencies basically acted with the banks, slapped AAA on toxic financial products that should never have received that, because they wanted repeat custom from the banks. They wanted more financial products to land on their desk to get fees for credit rating them. Yeah, finally, we could look at legally enforced minimum lending standards. So, commercial banks could be forced into being more prudent lenders by being told by the central bank that, they have to see a borrower's proof of income before they're allowed to grant a mortgage. Maybe, they could pass a regulation to say that the maximum mortgage that a bank is allowed to give to a borrower is 2.5 times the borrower's annual salary. That would work because if they're not borrowing so much, the chances of them being able to repay the loan will be greater. You could also limit the length of the mortgage term to 25 years. Obviously, the longer the mortgage term, the greater the chance of something going wrong, like the borrower losing their job and therefore defaulting on the mortgage. So maybe keep it for 25 years. It's about as long as you want to go. House buyers, must put down a deposit, a minimum deposit. That just shows that the borrower is responsible, that they've been able to save up money, and then also, I guess, the deposit insulates the lender too. That house prices could fall by 20% before they start making a loss on the loan that they've made. You could also restrict the availability of consumer credit, especially for young or low-paid borrowers. If another good video to watch is the BBC, it was a Panorama documentary on the so-called lie to buy mortgage fraud. I think if you actually look for Mortgage Madness, you'll find it on YouTube. And the program was made 5 years before the financial crisis hit. And basically what they found out was that people were turning up at banks and building societies, and they were just lying about the salaries that they were receiving in order to get much bigger mortgages than they would otherwise have been allowed to borrow. So why didn't the Bank of England step in to stop this mortgage fraud? It was absolutely endemic, as proven by this this Panorama program. As I say, it's well worth a watch. Very, very interesting. Again, for me, what this proves again is the economic value of morality. If you have a society where basically anything goes, it's very difficult for any market to function properly, because in the free market, all exchanges are voluntary. So, you're only going to go ahead with an exchange with somebody that you trust. So again, just thinking about this, you could get asked a question about the arguments for and against financial regulation. So what are the arguments against regulating financial markets? Number one is the cost of regulatory compliance. So you're going to have to employ people within the bank to complete all the paperwork that gets sent off to the central bank to prove that your commercial bank is acting within the central bank's regulations. That's going to cost money. That's going to make you less competitive. You could argue that if the regulations are too conservative, that's going to restrict the supply of credit, which will hold back economic growth. So, if the regulations are overly cautious, households and firms might not be able to borrow the money needed to either invest or buy consumer durables. And if you're a Keynesian, you would see that would slow the rate of aggregate demand, and therefore make short-run growth less likely. Financial regulations are ineffective because highly paid staff can always find loopholes around banking regulations designed by badly paid FCA, Financial Conduct Authority employees. I think this is hilarious. Yeah, and it's true as well that banks like Goldman Sachs hire the best, and the best go and work for them because they get paid the best salaries. In contrast, people that end up working for the Financial Conduct Authority tend to have less impressive academic credentials. They receive lower pay. So you're not going to attract the same amount of talent. So the staff at Goldman Sachs, whatever the FCA designed regulation-wise, they can find ways of avoiding those regulations, making the regulations ineffective. Yeah, financial regulation, like any other type of regulation, creates unintended consequences. So, you can try to regulate something with the best of intentions, but then human beings, being what they are, unpredictable, they might react in a manner that you didn't expect, and their reaction might create an undesirable consequence. And then the last one, regulatory capture. Regulation will never be strict enough according to the idea of regulatory capture, because there's a revolving door that exists between the big banks and the banking regulators, and that revolving door ensures that new regulations will be watered down, or even new loopholes will be designed into banking regulations. So going back to the FCA, you might have got a gig with them, and you want a pay rise. Well, what do you do? Well, you go and work for Goldman Sachs, and Goldman Sachs hire you not because you're able, but because you've worked for the FCAs, and you've got the inside track on the regulation, and you can tell them ways in which those regulations can be circumnavigated. So you go and work for Goldman Sachs for a while, pick up a big bonus or two, and then maybe Goldman Sachs, suggests to you that maybe it's time for you to go back and work for the FCA again, because in the meantime, regulations have changed, and maybe they need some more inside knowledge about how the regulatory system operates. So yeah, this slide here, originally in the 2008 banking crisis, many commercial banks were seen as being too big to fail. What that meant was that we couldn't allow insolvent private banks to go bust, because if that happened, companies wouldn't have access to cash, they wouldn't be able to pay their suppliers, they wouldn't be able to pay their employees. Ordinary members of the general public wouldn't be able to get hold of their savings if their bank had gone bust. They wouldn't be able to make payments at the local shop, because their debit card wouldn't work because the bank that issued the debit card is insolvent. So the idea was that we have to bail out these insolvent private banks, because if we don't, the whole economy will grind to a halt. So the slide there is that according to Glenn Greenwald, this is from the Guardian newspaper, many banks are actually now saying that not only are they too big to fail, but when their chief executives get caught laundering Saudi terrorism money or Mexican drug cartel money, these people that head up these banks, they can't be jailed because they're so important that the bank wouldn't be able to operate. And if the bank can't operate, that would then have impacts for the real economy. So yeah, they're too big to jail. Yeah, so another slide here just about the revolving door that allegedly exists between government and the banking industry. So there's regular movement between these two sectors. So the kind of allegation here is that the government doesn't actually work for the people. It works for whatever the financial services industry wants. In particular, one bank. See if you can guess which one. So if financial regulation isn't the answer, what is? Well, Austrian economists such as Peter Schiff argue that regulation is ineffective, expensive and unnecessary. And the best way of encouraging banks to behave responsibly and not to lend recklessly is to remove the implicit too big to fail status from private banks. So if banks knew that they wouldn't be bailed out, they'd be less inclined, for reasons of self-interest, to take silly risks. They wouldn't make stupid loans to people that couldn't repay just to make some really high rates of interest income in the short run. Because if they know that they're not going to be bailed out, they know that the losses are going to hit them. They're not going to be able to pass those losses on to the taxpayer in the form of a bailout. Same principle applies to deposit insurance for savers. Savers will only bother to look into a bank's activities if they know that there's a risk that they could lose their savings. Deposit insurance schemes in Britain, for example, mean that it's never been tested, by the way, but the promise is that if your bank goes bust and you've got up to £80,000 worth of savings, the state will repay you. So you don't really need to worry too much about what your commercial bank does with your money, because if something doesn't go wrong, mummy government will step in. Obviously that creates a massive moral hazard. It encourages you to take risks and park your savings in banks that are doing unwise things with your borrowed money, making unwise loans, to get the best rate of interest possible. If that deposit insurance was removed, then you might think a little bit more carefully about what your bank does with the money that you're saving with them. Yeah, so as I say, like the invisible hand of the market would then put pressure on banks to lend sensibly. Who would want to entrust their savings with a bank who lent in a cavalier fashion if there was no state-backed scheme that guaranteed deposits made by savers? Yeah, Schiff is right about this. So some films that you might be interested in about the 2008 financial crisis. So there's Overdose, the next financial crisis. That features all sorts of interesting people like Peter Schiff, Gerald Celente. Good watch. Inside Job, which is very good on corruption within the banking sector. Margin Call, and finally The Big Short. Okay, so this is the longest video that I've done to date, so I hope you found it useful. Happy to answer any questions that you've got when we next meet up, because I realise I've covered quite a lot of ground there.